This is the low of the morning. Markets are edging lower as investors are watching tax reform coming out of Washington. The Senate is beginning its markup of the tax plan that it released. It's beginning that markup today. Well, the House is hoping its vote on its own version of the plan happens by the end of the week. Joining us right now to weigh in is senior fixed income strategist at U.S. Bank Wealth Management, Dan Heckman. Dan, good to see you. Thanks so much for joining us.
Thank you.
What's been going on with markets here? I mean, we're talking about a reaction as all of a sudden we're getting close to the actual formation of a new tax code, and markets have been trading down.
Well, we think there'll be volatility around tax reform. There's certain aspects of both versions, the House and the Senate bill, that are very controversial. Here in New York, you're being impacted by taking away the SALT. That could lead to as much as a tax rate for New York City residents of 17%. That's pretty punitive.
Wow.
So, we think there's some volatility for the markets to wrap their arms around both these bills. There's also some provisions to delay the enactment of the corporate tax rate. That could create some volatility as well, Maria.
So when you bring up volatility, it's one thing we haven't seen. Volatility hasn't been there at all. It's been a slow, steady climb. And if we talked back in March or April and said, hey, we're going to be discussing a tax bill in November, we would have all said, I'm sure, market's going to have a major correction, a major crash even. But yet here we are. And I would argue that corporate earnings have been strong enough to hold us here, not necessarily give us the next leg up, but to hold us here until we get news on the tax cut. Do you agree?
I do agree, Mike. I think what we are seeing is about a 10% earnings bump in 2017. We expect with tax reform probably another 10% increase in earnings in 2018. So I think you're right about all that. I think some of the more extended parts of the market, like technology, for example, which is the #1 performing sector this year, probably has a little bit of a pullback in it. But outside of that, we see other sectors such as energy, for example. I think that's one of the most under-owned stories here is that Brent has gotten up over $64. WTI is approaching 57. We think if you get a lift out of energy, which is indicating stronger economic growth, certainly we think earnings could really propel this market eventually higher.
One of the biggest overhangs that we're going to see is next month. I mean, we're going to see the Federal Reserve possibly raise rates one more time. How do you think? I'm looking at the 2-year Treasury. I mean, it's at its highest levels we've seen since 2008. I mean, what do you make of this in this rising interest rate environment, and where should people go?
Kevin, there's no question, especially if you look, a lot of people focus on the 2 to 10 year, and that has narrowed. But look at the spread between the 5 and 10 year. That really is compressed. There's only about 35 basis points differential there. To us, that's all signs that the economy is humming along and economic growth is strong. And we expect the Fed to raise rates in 2017 in December. We also think they'll raise probably at least twice, maybe as many as 3 times in 2018. We think that's the wild card. If they raise as much as 3 times, then we'll get maybe a little bit concerned about that.
Last week, Alan Greenspan joined us, former Federal Reserve chairman, and asked him if the current Republican tax reform plans would move the needle on economic growth. What happens next? Here's what he had to say.
The federal debt is rising at a very rapid pace, and there's nothing in this bill which will essentially stop that from happening. So my view is that we're premature on fiscal stimulus, whether it's tax cuts or expenditure increases.
It's interesting that he would say, expenditure increases. That's why they want to do a corporate rate cut, so that businesses start expending, spending more money on expenditures.
Well, if anyone knows about an expanding economy and getting too hot, Alan Greenspan would.
Yeah.
So we think that going forward, that corporate tax reform is critical. We wouldn't be surprised if the rate settles at 25 versus 20%. We think that's probably going to lead to the bill passing eventually, in our opinion.
Donald Trump said 20% was his red line, Lee.
That's right, he did. Although he also said that he's willing to make deals.
Yeah.
And so I think the American people would be okay if you saw a compromise happening. But I also think that the American people are starting to get confused about this tax bill because there's so many different pieces that people are focusing in on. Mortgage deduction, SALT. What does this mean for me personally? And so I think I'm really curious what you think the most important thing that the American people or investors look at in this whole bill.
Well, I think they all look at their own individual situation, and here in New York is totally different from what we're going to experience in the Midwest. I think home ownership is something that's interesting, starting to tick up, Lee, a little bit, and I think taking away that mortgage interest deduction is a big issue for a lot of people across the country.
Yeah, for sure. That's been a major topic of discussion. Real quick, you still like equities here?
We do like equities. We think they'll have another good year in 2018.
We'll leave it there. Dan, good to see you.
Thank you.
Thanks so much. Dan Heckman joining us there.